Welcome back to my YouTube channel, Peas in a Pod. My name is Heather and I wanted to discuss today all about mortgages, specifically in Ireland. So myself and my partner just recently bought our first house here in Ireland and went through the whole mortgage process, and I hope you find this video helpful, and please let me know if you have any questions at all below in the comment section. Thanks for watching. Okay, so this is going to be a little bit of a series, I hope, because there's just so much to mortgages that I don't think it could all fit into one video. So the first one I'd like to do is about how to get mortgage ready. So, I think most people kind of know the starting point is the deposit. It can be important to know how to go about that, and also other things that banks will look for before they'll even start kind of, getting ready to approve you or anything like that. So the first thing I would kind of suggest, and that would have made our lives a bit easier if we had done it, was to just set up one or maybe two savings accounts. Basically what you want, the aim of setting up your savings account is just to make it as straightforward as possible. Like the approvers, the people who are approving the mortgage are just, people like you and me, so that you want to make their life a little bit easier, because the easier it is and the more obvious it is how much you can save, the quicker you'll get your approval and the less back and forth you'll have to do with the banks. The main thing is you just want to be able to show what is going out each month versus what you're coming in. So by setting up a savings account, you want to be really strict with yourself as much as you can, in that you only are putting money into that, because you don't want to be seeing money coming in and then a couple hundred coming out every month or whatever, because it's kind of, they're going to have to do more calculations then to actually come up with your affordability. So that kind of leads me on to the whole point of why you want to show your track record of savings. Because savings are how the bank will calculate your affordability. So your affordability will tell them, will show them how much you can afford to repay if you were paying a mortgage, right? Now, in saying this, in savings, rent is also included in savings. So if you're paying €1,200 a month on rent, that is counted as €1,200 towards your affordability, and then anything else you're saving will go on top of that, so that will only add to your affordability. So savings account is a great way, and just try and keep them as uncluttered as possible. The reason why you want to show affordability is, as I said, to show your ability to make your monthly repayments on the mortgage. Now, in saying that, when they're doing their kind of risk calculations, they also factor in an increase in interest rates and all that sort of stuff. So you will need to show more affordability than you're actually going to need to be repaying. So say if you want to have, repayments of 1,200,000, €1,200,000 of €1,200 per month, you want to probably be showing in around the €1,400 per month affordability. That's kind of what we were advised as well, and that can go up. That kind of the gap between those two figures can increase as well if you want to, say, for example, go for an exemption, which can be an exemption to the 3.5 times salary rule. So in Ireland, and I think in a lot of places as well, there's kind of a general rule mandated from the EU central bank that states a lending institute can only give out 3.5 times the household income as your loan value. If you did want to get an exemption to that rule in order to be able to borrow more, they generally will want to see you're capable of repaying if something did, like repaying even more, say if the worst case happened. You want to be able to show a track record of saving more than that required amount. And that track record usually is over a period of about 6 months. So they want to see proof of you being able to afford this repayment over the last 6 months. So that's kind of the main key. So your kind of two contributing factors to being approved for your mortgage is showing that 6 months worth of affordability. And as I said, that can fall under rent as well. So don't be worried if you're thinking, oh, I'm renting, I can never show that affordability. So the next thing I have in order to get mortgage ready, so that was kind of savings covered, right? And how to set up those savings and how to make them as simple and as clean as possible. The next thing would be to clear any debt. So any debt you have is taken off that affordability calculation that I was talking about just a minute ago. So if you're showing you can, save 1,500, but you have a €200 car loan coming out every month, that's taken off of that calculation. So you just want to bear that in mind, and if at all possible, especially if you do want to show the best affordability that you can to get the most mortgage you can get. And not everyone wants to get that. Some people, don't need that much of a mortgage, and they have enough and don't need to stretch out. But if you do want to get a little bit more than what that 3.5 times allows, the best way is to show your affordability, and any debts are going to take away from that. So one method, I know that I'm sure there's loads of videos on it, is just kind of like a snowball method. So if you did have multiple kind of debts, say for example, if you had a credit card balance, if you had a car loan, something like that, or a student loan, any of those kind of things, the snowball method involves kind of paying off the first one, the lowest value debt first, and then rolling it on through to the highest value one. So say you have a credit card that you need to pay €30 off a month, you pay that one off as much as you can. So just focus on paying that one off, so that's €30 a month, right? And then that one's cleared and gone, but you pretend as if you're still paying it, and then you add that onto your second repayment for, say, your what did I just say there, the credit card one, onto your car loan, and say that repayment is €200. Now add on as if you're still paying €30, and say now, okay, I'm paying €230. So you're just chipping away at those higher values, and the reason why it's kind of called a snowball is because as you're adding on more value to those repayments, it kind of tumbles off quicker off the overall debt total. So there's loads of videos that will probably explain it a lot better than I just did there, but I know that's a good way to kind of, focus on it bit by bit, but cumulatively kind of pay them off a little bit quicker. Okay, then the next one, a key thing to kind of know if you're trying to get mortgage ready, is to have clean bank accounts for the last 6 months. So similarly, the 6 months is kind of the golden rule for looking back. Now in saying that, if you do have any bad credit built up, such as like missed loan repayments or anything like that, I think that does stay on the ICB for up to 5 years. You can just check that out just to check if there is still any bad credit showing up, because that doesn't look great to the mortgages. But if you had it paid off, even though you had got bad credit, that will disappear off your record after 5 years. The other thing that banks do not like to see is any kind of betting transactions. So for the most part, the bank couldn't care less what you spend your money on. All they care about is that affordability that I was talking about at the first point. They don't care what you spend your money on, whether you go out all the time, whether you spend it on clothes, whatever. What they do care is if you spend it on betting. So the number one thing I would make sure is gone from my account at least 6 months prior to trying to apply for a mortgage is any sort of Paddy Power, any kind of betting agency that you might have a direct debit with, or that you might pay with online, and that would show up on your account. Even the lotto, if you pay for the lotto with your bank account, that will show up also. Because the reason why they kind of view it is as if you're willing to risk your own money, then potentially you're willing to risk their money, and it just comes up as a huge red flag for them. So it doesn't matter how much it is, even if it's only a tenner a week or whatever, they don't like to see it. So either just, like, I know a few friends that just get someone else to put it through for them, or they just do it in cash or whatever, however you want to do it, just keep it off the bank account. Okay, so the next one is, it's kind of linked to that affordability I was talking about, and really it's about setting out a budget. I know that sounds a bit boring and a bit detailed, but it basically, all you want to do is you want to have a look at what you have coming in each month and what you have going out, and just see where that kind of leftover amount leaves you. And you can calculate yourself then, what you're kind of going to be looking at in order to show them what you can prove. So sometimes even when you're ringing up different banks, they can ask you, okay, and how much are you saving per month? And you want to be able to have that figure off the top of your head, and then to be able to back it up with proof. And you don't need to I think you still need to focus on living your life as well. You don't want it saving for this mortgage to be so consuming that you're just not enjoying your time. Because, like, for most people it can take a while to save up, and you don't want to have, a crap life for a year with no frills or anything like that. So make sure you still enjoy yourself, but maybe set aside a pot of money that you go, okay, this is my discretionary money and I can spend this however I want and not feel guilty about it. The way that we kind of found worked really well was as soon as we got paid, we put a dedicated amount straight into the savings and decided, okay, we were going to leave ourselves with X amount of money to spend for that month. And that was it. We never went back into the savings again. And as we were coming through the month, you'd see exactly how much you're spending. So that saving at the start of the month, as opposed to towards the end of the month when you've already spent your money, I found really kept us on track, because you could kind of see halfway through the month how you're tracking. Like if you're already halfway through your budget, 2 weeks or a week or week and a half in, you're going, okay, I need to kind of hang off a bit here and maybe wait and slow down things. And that kept us really focused and kind of kept us on track. So yeah, that's kind of the main thing around savings and kind of budgeting. The last thing for getting mortgage ready would be for your job status. So particularly at the moment, banks are probably a bit more strict on this than they would have been previously, but they will require, before you draw down your mortgage, they will require that you are in a permanent job and you have passed your probation period. For us, I was only new in my job. When we started the mortgage application, I think I was in my job maybe 4 or 5 months, but they would still let us go through the process with just the caveat that we couldn't draw down, we couldn't actually take the loan of the money until I had passed my probation period. So they will let you kind of go ahead with it, but they won't give you the actual money until that probation period has been passed. So that's a big one. I know with people who are self-employed, they generally require 3 years of previous books, so to see what your kind of income was over the last 3 years in order to allow you to go ahead with that process. So it's just all kind of about risk mitigation for the mortgage supplier. I know as well, in terms of some other jobs, just a little side note, is if you're in a kind of a government or a salary scale job where you go up, you're guaranteed to go up a certain value each year. Certain banks will actually factor that in, and they'll bump you up to pay scales in that 3.5 household income loan to value calculation. So that's one thing to know as well if you are on a salary scale. So they're my main tips, my top 4 or top 5 maybe, for getting yourself mortgage ready. And I'd love to hear if you have experienced any other tips that you'd like to share, or if you have any questions on any of the ones that I've listed. So thanks very much for watching, and hit the subscribe button to see the next in this mortgage series. Thanks.